My name is Nick Webb, and I'm the Director of Risk Management here at Ryerson. What that encompasses is basically monitoring, analyzing, trading in the commodities markets, both for Ryerson's own regard, as well as for our customers to hopefully come up with ways to manage price risk. We've got a number of slides that we want to run through here today, about 20 to 25. So we're going to have to hop into those in a fairly quick fashion. But what I do want to do is give a quick plug to say, if you find this information helpful, if you find it interesting, you want to dive into some of it in a little more detail, certainly reach out to your sales representative, and we will do our best to make sure that we set up, one-on-one calls with you and your team so that we can dive into all of these charts and all of this data in more detail throughout the course of this year. So certainly keep that in mind as we run through all of this data. I know all of you have been fully inundated with macroeconomic data from Alan below already. I'm sure the presentation was phenomenal. We do have a couple additional macroeconomic slides that I want to run through because I think it's really important to set the stage for the framework by which we may be operating in 2021 within the commodities landscape. So let's go ahead and hop into the presentation, and we'll start off on the macro side. So first things first, you can't talk about the macro environment without talking about the Federal Reserve balance sheet. It's been no secret that there's been a lot of stimulus that's taken place over the last 12 months, but just looking at it graphically is pretty staggering. So over the last 12 months, the Federal Reserve has added about $3 trillion, and yes, that's with a T, $3 trillion to the Federal Reserve balance sheet, taking that balance sheet up to about $7.36 trillion. Now, what's perhaps equally as staggering is the fact that when you compare that increase back to the increases that were done to the balance sheet back in 2009, it really dwarfs those increases. It's about threefold the increases that we had done just to stimulate the economy in the face of the financial crisis. So there's been a very quick, robust, and swift movement by the Federal Reserve to backstop the economy in the face of the coronavirus. And it certainly has fueled a lot of risk assets, be it commodities, equities, you name it. We're seeing a lot of reflation in the economic landscape. Perhaps equally as interesting is when you consider that data against some of the other central banks, which is shown here in this chart. When we compare what the Federal Reserve has done over the last couple of years, maybe even couple decades, to what's being done at the ECB, which is the European Central Bank in the green line, or the Bank of Japan, which is shown in the yellow line, you can see that although we've been very stimulative here within the United States, the efforts have been dwarfed by the actions that have been taken by the Bank of Japan and by the ECB. What does that mean for 2021? Well, it may mean more stimulus from the US government. It may not, but nonetheless, we can certainly see from this chart that there's room that if we're trying to catch up to the other central banks around the globe on a GDP, on a balance sheet as a percentage of GDP basis, there's certainly more room to grow. Moving on to why that's all important. Well, as the Federal Reserve is printing more and more money, and as central banks around the world are printing more and more money, that's adding more supply of dollars into the landscape. And when you add more supply of something and demand is relatively stable, typically what that does is it has a negative impact on price. So what this chart shows is the DXY index, which is looking at the US dollar relative to a basket of global currencies. You can see that back in March of 2020, there was a pretty swift move higher from about 96 to right around 103 on the DXY index. And what that was is really a flight to quality, meaning when things get scary in the markets, when the coronavirus was starting to hit the United States and the European area, there was a large flight to move out of risky assets like equities, metals, things like that, and move into safe haven assets like gold and currencies, safest of which being the US dollar. So there was a large move higher in the US dollar, which tended to weigh on a lot of other risk assets. Since then, however, as we've added more, as the central bank has added more stimulus into the economy to the tune of $3 trillion on the balance sheet, that has had a weakening effect on the currency. And as many of you may know, what the US dollar does tends to be inversely related to what happens to the price of commodities. And we're certainly seeing that playing out over the last 9 to 12 months. So where do we go from here? You can see it on this chart. We're at basically year-to-date lows as we sit here right now. We're heading into a new administration with the Biden administration. We've got a blue wave across the House and Senate. So, what that may pose from a stimulative standpoint, it may be more of the same, but we'll have to see what's in store here in the coming weeks and coming months. Similarly, what the Federal Reserve printing has done, at least to some degree, is it's had a reflationary impact to manufacturing PMIs. The PMI is the Purchasing Managers Index, and you can see that going from left to right, what this data is showing is going into the coronavirus, a lot of the manufacturing data points were kind of muted. You see a lot of yellow in there on the left-hand side. Basically, any data point that's right around 50, and these are regional, so you can see all across the globe. It was really kind of the same story. As we headed into February, March, April, May, we got some of the weakest Purchasing Manager Index data that we've ever seen on record. And it's no surprise. Governments, economies were literally brought to a halt. Now, a couple things to note from this. China, which you can see about 4 down on this chart, they were the first ones to enter this madness. They were also the first ones to really hop out of this madness and come back to a reflationary environment. And you can see that their economic data actually started to improve well in advance of a lot of the other regions of the world. Now, it took a couple extra months, but many other regions of the economy have joined the party. And as we look over on the right-hand side, as we think about the backdrop to which we start 2021, the manufacturing PMI data is quite strong, and it's pretty unified across most regions of the world. So a lot of this printing that's been taking place by the Federal Reserve, the Bank of Japan, and the ECB has at least had some impact on this reflationary environment. So what does all that mean? We'll hop into all of the individual metals here in 1 second in alphabetical order because I don't want to choose favorites. But as we look at the Bloomberg Industrial Metals Index, we can see it very clearly right here. Despite the fact that we've had a global pandemic throughout the course of this entire year, we've seen metals prices reflate to well in advance of where we would have been prior to entering this whole mess. And it's even exceeded that to the tune of about 20 to 25%. So we've got a situation where we've got a recovering economy, we've got a lot of stimulative money floating around in the system, and all of that's really a recipe, and it's been a recipe for higher metal prices up to this point. So let's go ahead and hop into each one of the individual metals, first starting with aluminum, where there's no shortage of things to talk about. This is a chart of the London Metal Exchange aluminum ingot price. And this is a pretty long-term chart because I think it's interesting to have historical context when we think about where we've been versus where we're going to head in 2021. And I drew in this white line down along the bottom of the chart, which is, I would argue, it almost acts like an inflation line. It's slightly gradually increasing over time. This chart goes all the way back to 1985. And what you can see is that every time the price of aluminum ingot has dipped down to that price level, it's acted as support. And it makes a lot of sense because when we think about how aluminum is made, aluminum smelters at some price, if things get so ugly and so low, aluminum smelters will actually shut in production when they say it doesn't make sense for me to produce that next incremental ton of aluminum. So they'll actually shut in production. And when that happens, it better balances the supply-demand dynamics. We saw that happen back in March of 2020 when things were getting crazy all around the world. Demand was coming to a halt. Prices actually got down to about 68, 69 cents. Aluminum smelters shut in production, and the price started to recover a bit, in addition to the fact that we had a lot of stimulus measures. Now, it doesn't look like the recovery has been all that robust, but make no mistake, that recovery is going from about 68 cents all the way up into the low 90-cent range. So we're seeing about a 35% move in the price of aluminum ingot. It still pales in comparison to some of the rallies we had seen back in the mid-2000s, the commodity super cycle from China, but nonetheless, the recovery has been real. And it looks like the demand environment within aluminum is pretty strong, whether we're looking at automotive demand as it relates to aluminum, or we're looking at can sheet, People seem to be drinking a lot more soda or perhaps beers over the course of 2020. And a lot of that's really fueling some of this demand as well. So there is a real, it's not just a supply story, there is a demand story within the aluminum side as well. Additionally, it's difficult to look at LME prices without also considering the Shanghai Futures Exchange, which we've labeled here as the sheaf. The yellow line is going to be your Shanghai market. Your white line and blue area is going to be your London Metal Exchange market. It's the same data as the chart before, just on a shorter time frame. What you can see is, generally speaking, the two markets are pretty tightly correlated. And it makes sense because the Shanghai Futures Exchange, it's warehousing the exact same product that the London Metal Exchange would be warehousing, which is aluminum ingot. So it makes sense that the prices would typically be correlated. What's interesting is, and it happens on occasion, but it certainly happened over the course of 2020. I mentioned this a few slides ago, but China was really the first one to enter the virus lockdowns and things like that. They were also the first ones to reemerge from the chaos. And that's really kind of depicted within the aluminum market as we see here in this chart, because you can see that the yellow line really was kind of the leading indicator on this recovery and this move higher in price for aluminum ingot. Now, it's severely outpaced the price of London Metal Exchange pricing, as you can see here in this chart. And when that gap gets big enough, what happens is there are traders around the world who trade what's called the arbitrage, which just means there's a gap between price between the London Metal Exchange and the Shanghai futures market. And when that gap gets big enough, traders will actually go in and they'll buy futures contracts from the London Metal Exchange. They'll buy metal, they'll put it on a boat, they'll insure the boat, and they'll ship it to China, and they will deliver that metal into the Shanghai futures system. What they're attempting to do is really profit on the fact that you can buy metal on the LME cheaper than where you can sell it on the Shanghai Futures Exchange. And all of that is really an attempt to tighten that gap that we're seeing between the yellow line and the white line. So up until this point, China really has been the leading indicator for where aluminum prices have been going. The gap is still quite large, but you can see it's already starting to converge a little bit. Now, we don't know for sure whether that tightening of the gap is going to come by way of the LME moving higher, the Shanghai futures market moving lower, or perhaps a combination of the two. But nonetheless, it's still pretty wide. And as we look at this on a historical context, it's got potentially some room to tighten. And I think we may perhaps see that here in the coming months, but time will tell. Additionally, on the aluminum side, we've got the raw ingredient going into aluminum production, which is alumina. And the predominant market for alumina is going to be the Australian market. And here you can see the chart looks almost the same as what we've seen across a lot of different commodities, a lot of different risk assets, which was we hit March and things fell off a cliff. The recovery has been robust though. As smelters have come back online, the demand for alumina has increased. And we're now back to levels that are basically right at or even slightly in excess of the pre-COVID price levels. Now, Harbor Aluminum, which is a subscription service in aluminum, they're out there calling for $400. They're expecting this trend to continue. I don't know whether or not that's going to be the case, but certainly the recovery has been robust to the tune of about 25, 30% over the last 9 to 12 months. So there is a real cost push support argument for this rally in aluminum up to this point. Now, lastly, on the aluminum side, a little bit of stability, probably a welcome surprise for many of our customers. We're looking at aluminum premiums here. So I've highlighted here in the middle section, this is actually a screenshot of the futures market for Midwest aluminum premiums, which is the premium to get Midwest aluminum into the Midwestern portion of the United States. So it's that value-added premium that basically anybody buying domestic aluminum has to pay. What you can see here is even though the spot market or the front end of the futures curve is right around 15 cents, as we look forward, 1, 2, 3, 4 months into the future, the price starts to erode a little bit. And there's actually quite a bit of stability as we look out 12 to 18 months into the future. I would argue that the futures market is suggesting that there may be a little bit of price depletion or price degradation in the premium market. Now, why would that be the case? A couple potential examples would be if in the event the quota mechanism on Canadian aluminum ingot were to get alleviated, that would certainly open up the market a little bit and soften the premium to get aluminum from Canada, which is the biggest exporter of aluminum ingot, into the United States. That would certainly have an impact, and that's a potential for 2021. The other potential, as we head into a new presidential administration, there's a possibility that a lot of these tariff mechanisms that have occurred and these protectionism measures that have occurred over the last 4 to 6, maybe even 8 years, some of them may get moved to the sidelines and get taken down. And if that were to happen, I think we would see a little bit of degradation in the price of premiums. Whether or not those things happen, I don't know, but the futures market, as it relates to the expectation of futures traders, that appears to be what's being built into the futures market right now. Now, moving on to the carbon side, where there is plenty to talk about in this current environment. Starting off with the price of hot roll coil, which is going to be a barometer for really all things carbon, sheet at least. But it's going to have correlations to tubular products, even plate products. This is the spot hot roll coil futures price. And unfortunately, the hot roll coil futures market only goes back to 2008 because that was when the Chicago Mercantile Exchange launched this contract. But as you can see here in this chart, we are at record highs as it relates to the hot roll coil futures price. Now, you might say, well, the futures price isn't the CRU. Well, they really kind of are one and the same because the futures market does actually settle against the CRU. So there should be a very, very high correlation between what the index is, being the CRU, and what we're seeing here on this chart, which is the futures price. But nonetheless, we're above $1,000 a ton. We haven't seen these price levels since 2008. And if we had been able to move this chart back just another couple months, you would see the only other time in history that hot roll coil prices have been in excess of $1,000. Now, that's a little bit of good news, a little bit of bad news, because what I will remind viewers of is, as you can see here in this chart, even though back in mid-2008, we saw prices up around $1,100 per ton, it was only about 6 to 8 months later that we saw prices dip down to as low as $375 on the CRU. Now, we did also have the great financial crisis at that point in time. I'm not here to suggest that we're going to have that situation happen again, but nonetheless, it is certainly an analog that we should be somewhat cognizant of, the fact that the last time we were at these price levels, we saw that sort of price move. Not at all suggesting that that's going to happen. I think we're in a very different environment this time around, but it's certainly an interesting little data point to keep in the back of your mind. As we look at U.S. carbon prices relative to prices around the globe, I've overlaid the price of hot roll coil here in this chart to the price of Chinese hot roll coil, which is shown in the yellow line, and then the green line, which is European hot roll coil prices. And you can see that the divide, similar to what we saw on the aluminum chart, the divide is ever growing. And as we sit here today, we've got about a $400 spread between where the price of foreign hot roll is and the price of domestic hot roll. Now, when that happens, at least historically, that would mean that you would go out and you'd import foreign product, you'd bring it into the United States. Eventually, that helps to balance supply-demand conditions here in the US, and then you'd start to see prices correct. The one caveat to that is we're in a very protectionist environment right now. We've now got tariffs we've got to pay. Some of those tariffs, at least in the case of China, are in excess of several 100%. So we still can't touch Chinese product here within the United States. Canada can to a degree, but within the United States, we've got to be cognizant of the fact that when you add in tariffs, you add in freight, there is a larger gap that needs to occur in order to really warrant or garner those import tons to come to the United States. We may be around that territory still, though, with the price at this wide of a gap. But why is the United States at such a premium in price to the rest of the world? Well, I direct you to this chart, which I think is personally one of the most important charts to keep an eye on as we progress through not just the next couple months, but really over the next several quarters through 2021. give the steel mills credit. The steel mills, when they saw the pandemic coming, they were extremely quick to take capacity utilization, which is all of these data points here are represented by a percentage, which means if there's X number of tons that the U.S. mills can produce, they are producing at X percent, and that's shown here within this chart here. So pre-COVID levels, normal utilization is somewhere in the realm of 80 to 85%. That means mills are operating pretty close to full capacity. They've got a little bit of extra room in case demand ramps up. That's kind of a normal environment to a decent environment, I would say. When they saw the pandemic coming and they saw demand basically getting shut down, they took utilization rates down to about 50%. And again, I give them credit for it because they did recognize the hurdles that were coming their way. They took a lot of assets down. Now, since then, obviously, we've talked a lot about the recovery on the demand side, which has been strong. It's been robust. You can see it right here. The recovery in utilization rates has also been robust, and it's been a fairly straight line, but it has been outpaced, it seems, by the demand curve. So we simply have a situation where demand has come back online at a slightly faster clip than the supply side. And we're being left in situations where we have pseudo shortages across North America for carbon products. And that may be short-lived, but nonetheless, it's real. And why are those shortages happening? Well, there are a couple things that I'll point to, and I'll just very quickly point to them anecdotally, but U.S. Steel had a number of assets that were offline. They're starting to bring those back online. Cliffs, ArcelorMittal, there's a merger that's taking place right now. That merger was being held up by antitrust ruling. We're now beyond that. So there is an expectation that at some point, it probably makes sense for Cliffs, who's the acquiring entity, to flip on those assets and bring the old ArcelorMittal assets online and further improve the supply side of things. Additionally, and it's crazy to say, we've also got strikes at NLMK, which need to be resolved. We've got literally a cybersecurity attack at a Canadian mill. All of these factors are creating what I'll call a perfect storm on the supply side to keep things a little tighter than they need to be. I don't think that all of them are long-term in nature, but we're certainly in an environment right now where the mills are in effect in a name your price environment. I mean, for any incremental ton that's needed out in the marketplace, they're essentially saying, if you want it, you got to pay up for it. And that's why we're seeing hot rolled coil prices in excess of $1,000. Additionally, and you know, not to only put it on the supply side, there's also a real cost push argument to be made. As China, which we talked about a few slides ago, as China has recovered from their epidemic, and they've come on very, very strong over the course of 2020, the price of iron ore, which is one of the raw ingredients going into steel production, has gone from about $100 per metric ton up to about $165 to $170, which is pretty darn close to all-time highs for the iron ore market. So China's come on strong. They're producing a lot of steel, and the price of iron ore is going higher. China's recognizing that. And in the last few weeks, what's been very interesting is China has started to try and take efforts to put the kibosh or put a lid on this iron ore price rally. And it's a little bit of a trade spat that they're having right now with Australia. But what they're doing is they're actually saying, we're going to start producing a little less steel. We're certainly going to start producing a little less steel from iron ore because the price of iron ore has gone up so much. And what they're saying is we're going to try and limit our efforts to some degree to slow our buying of iron ore from Australia. So it's a trade war, sort of, not exactly, but kind of. And it's definitely price oriented. But what are they doing in turn? Well, in the last couple of weeks, they've lifted their scrap import ban. So for the last several years, China was very, very cognizant of the fact that they did not want to touch the import market for carbon scrap. They wanted to be very reliant on their own internal demolition projects and things like that. Well, now that they're kind of poo-pooing the iron ore market for Australia, they are recognizing that they need more raw ingredients for steel production. So they're saying, well, we got to lift the import ban on foreign scrap. So what does that do? Well, all of a sudden it immediately puts a bid or a very strong rally into the price of carbon scrap. And you can see that here in this chart as well, which shows carbon scrap just in the last couple months has gone from 300 to 350 all the way up to about $500. Now, I will be the first one to tell you that electric arc furnaces, those who are producing steel from scrap, even with this rally of scrap going to $450 or $500, even with scrap at $500, if the hot roll coil price is at $1,000 and that spread is $500, if we compare that to historical norms, that is well in excess of where the normal spread is between scrap and hot roll coil. So what does that mean? It means that every mill, both domestically and on a foreign basis, is able to make money at these types of price levels. So I don't think it takes any kind of rocket scientist to make the argument that every mill has got to be contemplating bringing on every asset that they have that's currently sitting offline. So as we think about those capacity utilization numbers, I think it's only a matter of time until the mills start to recognize, hey, prices are high. The time is now that we can make some money, and I think they're probably going to take those efforts. Last slide on the carbon side, and I think this one's a very interesting one, but this is looking at the futures curves for hot roll coil 6 months ago, as shown in the blue line, 1 month ago, as shown in the green line, and current, as shown in the orange line. And what's interesting about this is a couple things. One is this is the market's expectation of where futures prices or the future of hot roll pricing will be as we look forward in time. As you can see, they're oftentimes very, very wrong. So this is not a take this as gospel for where prices are going to go, because as you can see, if we trusted the blue line, we'd be incredibly wrong on where the price trajectory ultimately went. But what they are is a snapshot at any point in time, given all of the information that we have at that moment in time. 6 months ago, the market was basically saying the price isn't going to go above $550. As we fast forward to just a month ago, the front end of the futures curve has gone from about $500 a short ton all the way up to $900. Fast forward to now, we're now in excess of $1,000. We're even verging on $1,100 on the front end of this curve. What's equally as interesting, though, is the shape of the curve now is very heavily downward sloping, or backwardated is the futures term for it. Now, what does that mean? That means that there's an expectation in the futures market that in the coming months, we're going to see prices degrade. Why would that be the case? Well, for a number of the reasons that we just talked about, which is a lot of these supply side issues that have been occurring, whether it's a cyber attack, whether it's a strike, whether it's a merger agreement, all of them at some point we believe will get pushed behind us, and supply should normalize. And if and when that happens, prices may normalize as well. And what does normalize mean? Well, time will tell. We'll have to see where things go. The timing of this is going to be very tricky, but as it stands right now, the futures market is saying we're going to see peak pricing in Q1. I don't know whether that's going to be the case. I don't think anybody out in the market would have suggested, 2-3 months ago that we would have seen prices in excess of $1,000. That's why we play the game, folks. It's a wacky world, but it's certainly something that we are keeping a very, very close eye on, because it's very important for our business. We know it's very important for all of our customers' businesses, but I can tell you right now, the market is extremely tight in its present environment. I think there are some things around the corner that should help to normalize some of those factors on the supply side. And then lastly, by no means is the stainless market boring, but relative to its aluminum and stainless brethren, it is a boring market. But nonetheless, we'll address it here in the next couple slides. First, looking at the price of nickel, which is going to be the predominant factor going into the stainless steel surcharge. We've got a long-term chart here showing all the way back to 1985. I've again drawn in this white kind of support line, which again sort of acts like an inflationary support line. You can see that anytime we've gotten down to it, it's acted as support. We got pretty darn close to that support line back in March of 2020, which was right around $5 per pound. Again, similar to aluminum smelting, when nickel prices dip down to $5 or slightly below $5, you do start to dig into the cost curves of nickel miners, meaning it doesn't make economic sense for some miners to actually pull metal out of the ground because they can't do it for a profit. So what do? They shut in their mines. And we did see some of that over the course of 2020. When that happens, supply-demand conditions normalize, and prices start to move a bit higher. Even though this chart doesn't really show it, it looks like a very muted move. That price move going from about $5 per pound up to just over $8 per pound, that's about 60%. So we're not talking about small potatoes here. It pales in comparison to the super cycle moves we saw back in the mid 2000s when nickel went well in excess of $20 per pound. I don't think that's in our future necessarily, but we've certainly seen a big move already. Now, why did we see that move back in basically 2005 up to $20 per pound? There were real shortages of metal, similar to what we're currently seeing in carbon. And when that happens, it's sort of name your price. I don't think, as we look here at this chart of LME nickel inventories, I don't think that's really in the cards. There was a risk back in late 2019 when Indonesia announced their nickel ore ban, their export ban. And there were real concerns that as the electric vehicle market was strengthening, as the stainless steel market was fairly strong, there were real concerns that we were going to run out of nickel units in the face of that export ban from Indonesia. Since then, they lifted their ban, inventories have normalized, and as you can see here in this chart, 2020 has seen nothing but stabilized inventory levels within the nickel environment. So even with a burgeoning electric vehicle market, which nickel goes into the lithium-ion battery, even with all of that occurring, even with the reflationary environment on the stainless side, I don't foresee at this present time any situation where we run out of nickel units. So I don't think we should see any kind of scares with regards to that at this point in time. We talked about this briefly, but we got to touch on it again because carbon scrap pricing does go into the surcharge mechanism. It is worth noting that scrap prices are basically at their all-time highs. So even though carbon scrap doesn't make up a large component of the surcharge within stainless, it is certainly going to have an impact, at least in the short term, nonetheless, because scrap prices are up around $500 a metric ton. And then lastly, a little bit of stability and a breath of fresh air for our consumers. The price of chrome, which you can see here in this chart, this is a 5-year chart. When chrome gets going, it can go pretty quick and it can get pretty scary, as shown back in 2016 to 17. As we sit here today, it's kind of smooth sailing. And I can actually report that we actually have the official numbers for Q2 already. And the expectation is that we're basically looking at a flat quarter-over-quarter chrome price. Now, South African chrome, that's the predominant supplier to the world market. You can see that back in early 2020, South Africa did get a small coronavirus outbreak, and there was a little move higher in the price of chrome because there was a fear that, if South Africa is having an outbreak and they're the main supplier of chrome, there could be shortage situations. That was very quickly abated as they got things under control within that country. So I'm ending the presentation with a little bit of a breath of fresh air, a little bit of stability. I want to thank everybody for partaking in the ENGAUGE 2020 conference that Ryerson's put on for everybody. Again, I really do want to push the idea that if you found this information useful, if you found this information interesting, certainly reach out to your sales reps. I want to make myself available to really run through all of this data and more with all of you and hopefully do a deeper dive into a lot of this data because we're limited on time. But I really do want to thank you for your business. Thank you for your time. Hopefully this has been helpful. And we hope you enjoy the rest of the ENGAUGE 2021 offering. Thank you.